welcome to the deep dive. You've handed us quite a stack of sources here.
Yeah, it looks like economic data, central bank stuff, market reports, charts, the whole nine yards.
All focused on giving you a clear picture of the Forex market outlook. We're zeroing in, really, on the U.S. session for June 12, 2025.
And our job, well, it's to cut through all that information, isn't it? We want to pull out the key nuggets, the important bits directly from your material.
Right. Help you understand what's really driving the currency markets right now. Think of us as guides through this pile you gave us.
Exactly. Your expert guides navigating this landscape of information.
Okay, so we've got, surprising data, some subtle shifts maybe in central bank talk, and some, well, really eyebrow-raising numbers on how the big players are positioned.
It's definitely a complex puzzle, but your sources, they give us the pieces we need.
Okay, let's unpack this then. What are the key market drivers jumping out right away from these sources you shared?
Well, we have to start with today's U.S. data, right? That's often the headline mover, especially for the U.S. session.
Makes sense.
And the big surprise this morning, June 12th, that was the May Producer Price Index, the PPI.
Ah, the PPI. Now, after last month's CPI, the consumer inflation numbers, they looked a bit softer. So were people hoping PPI would, follow suit? Confirm that easing?
That was the hope, yeah. But your sources show the PPI data. It actually painted a significantly different picture.
Oh, how so?
The core PPI, that's the one stripping out food and energy, it jumped 0.3% month over month. A big surprise.
0.3%. What was the forecast?
Forecast was for a drop of 0.4%, so a huge reversal.
Wow.
And the main headline PPI, that was up 0.2% when folks were expecting a drop of 0.5%. So both numbers, much hotter than anticipated.
Okay, so producer inflation, it seems maybe more persistent than people were banking on.
That's the worry. And the market's definitely watching now. Will this feed through into future consumer prices? That's the big question.
What about the labor market data today? Anything surprising there?
Less of a surprise, really. U.S. unemployment claims, they came in a little better than forecast. 242,000 versus 247,000 expected.
So still showing resilience.
Yeah, continued resilience in the labor market, which is, another piece the Fed has to factor in.
All right, let's hop across the pond then. Your sources flag some tough data from the UK too.
Absolutely. The UK's monthly GDP for April that came out today, it contracted minus 0.3%.
Worse than expected.
Yeah, worse than the minus 0.1% forecast. And it reversed the growth from the previous month. So yeah, a clear signal of economic weakness.
And the sources mentioned other weak spots.
Yeah.
Trade, production.
Correct. Weak goods, trade balance numbers, declines in industrial and manufacturing production. It all sort of reinforces that picture of a struggling economy. And what's really fascinating, or maybe worrying, is this weakness is happening alongside persistently high wage pressures. That wage data came out earlier this week, June 10th.
So wait, slow growth and high wages, that sounds like stagflation risk, doesn't it?
That's exactly the risk people are talking about. And it makes the Bank of England's job incredibly difficult.
How so?
Well, they need to fight inflation, right?
Right.
Which is partly driven by those wages. But cutting rates to help the weak economy, that could make inflation worse. It's a real bind.
And your sources said this is weighing on the pound.
Yeah, this exact dilemma. You could see it weighing on sterling, especially in pairs like GBP-JPY reacting negatively after that weak GDP number today.
Okay. Any key Eurozone data in your stack? Anything major?
Just a quick mention, Italian quarterly unemployment was a touch higher than expected, 6.1% versus 6.0%. But the bigger Eurozone story in your material was, obviously, the ECB.
Right, the European Central Bank. They just made a move.
They did. June 5th, they cut their main deposit rate by 25 basis points, down to 2.00%.
And their reasoning.
Your sources note it was based on their updated forecasts. They see inflation easing towards target, helped by, lower energy prices and the euro getting stronger recently. They're projecting 2.0% inflation in 2025, 1.6% in 2026. Growth forecast is 0.9% for 2025.
Okay, but after the cut, are they signaling more cuts coming soon? Or are they maybe pumping the brakes a bit?
That's the key question. Your sources really emphasize the ECB is going data-dependent now, meeting by meeting.
Right.
And comments from officials are interesting. Mueller still sees inflation near 2%, but Schnabel, another official, suggested the cutting cycle might be coming to an end and that financing conditions aren't too tight.
So that implies maybe a pause after this cut.
That's the implication, yeah, a potential pause, which maybe counterintuitively could actually support the euro if the market stops pricing in lots more cuts right away.
Interesting. Any side notes from the Eurozone material?
Just that Bulgaria's plan to adopt the euro is still on track for January 2026, according to your sources.
Got it. Okay, let's turn to Japan. What's the latest read on the Bank of Japan from your sources?
Well, the BOJ kept their policy rate steady at 0.5% back at their May 1st meeting. They did trim their growth forecasts a bit, citing things like potential U.S. tariffs.
But they still think inflation's on track.
They stuck to that view, yeah. Governor Ueda has talked about wage growth eventually supporting future rate hikes. But, the overall tone from that May meeting, the market saw it as surprisingly dovish. It pushed back expectations for the next hike.
So what now?
Your sources suggest the BOJ probably kept that patient stance at their meeting this week, June 10th and 11th. The market's basically watching now for any hint of more hawkish guidance, anything that might support the yen, which has been, quite weak lately.
Shifting gears slightly, trade policy always seems to be lurking in the background, adding uncertainty.
Yeah.
What did your sources flag there?
A couple of things. There were reports mentioned that key parts of a U.S.-UK trade deal might get enacted soon. That could be a positive for the pound, potentially.
Yeah.
Separately, sources noted comments from former President Trump suggesting he's willing to extend some broader trade talk deadlines, but also that letters are coming soon. So, it suggests ongoing talks, potential volatility still simmering there.
And the Fed even mentioned trade uncertainty.
All right. Yeah. The Fed statement specifically noted increased trade policy uncertainty as a risk factor they're watching.
Good point. Okay, let's just quickly run through some baseline numbers your sources highlighted. Rates, prices.
Sure. Current benchmark interest rates, Fed's at 4.25% to 4.50%. ECB, as we said, now 2.00%. And the BOJ is at 0.50%.
And price action.
USD has shown real strength, rallied to multi-week highs above 1.1500.
Yep.
GBP GTPI, despite that weak UK GDP, it's sort of consolidating around 195.55 after moving up recently.
And USD liquidity was mentioned.
Yeah, your sources specifically called out the high liquidity in USD. Makes it a favorite for the bigger players, especially when, trading sessions overlap.
Okay, now, this is where it gets really interesting, I think. It potentially explains the why behind some moves. The Commitment of Traders report, the COT report.
Right. This gives us that peek behind the curtain. Based on data from June 3rd, released June 6th, shows what the big institutional players, hedge funds, speculators are doing in futures.
And it reveals some pretty stark differences in opinion.
Oh, yeah. Striking divergences. For the euro, large speculators significantly increased their net long contracts, up to positive 82,800 contracts.
Wow. Okay, so big money is betting the euro goes higher. What about the pound?
GBP saw a small decrease in net longs, but still solidly net long at plus 35,200 contracts. So institutions still broadly bullish on sterling, too.
Now the yen. There's been a lot of chatter about yen positioning. What does the COT show?
Yes, this is. Well, it's huge. Speculative net longs in yen futures, while they came down a tiny bit, are still massive, plus 151,100 contracts.
That's a massive bet on the yen strengthening.
An enormous bet, yeah. Essentially, it's like being heavily short pairs like USD-JPY or GBP-JPY, betting against them. It's a very, very crowded trade.
Fascinating imbalance. Okay, what about the commodity currencies, the CAD, the Aussie?
Canadian dollar futures saw a big increase in net short positions, up to minus 108,400 contracts. So growing bearish sentiment towards the CAD from institutions.
And the Aussie.
Similar story. An increase in net shorts there to up to minus 63,200. Rising bearish institutional bets against the Australian dollar.
And the Kiwi, the New Zealand dollar.
Net shorts in NZD futures reduced slightly, but still firmly net short at minus 23,700 contracts. Broadly bearish institutional view there as well.
Okay, let's sum up that COT picture then. Big money is bullish, EOR and GBP. Significantly bearish CAD, AUD, and NZD. And holding an extremely large net long position on the JPY. That's a lot of conviction in different directions.
It really is. And the overall synthesis from your sources kind of ties it all together. You've got conflicting U.S. inflation signals creating Fed uncertainty, the U.K. facing that tough stagflation picture, the ECB perhaps pausing, which might support the euro, and then those extreme JPY speculative longs. They really stand out as a potential source of major volatility if that trade unwinds.
Okay. So with all that context, the data, central banks, trade whispers, and that really telling COT report your sources then used a multi-factor approach to pick 5 specific currency pairs for a closer look.
Right. They weighed things like volatility, liquidity, sentiment spikes, social media buzz, and tried to get a diverse mix, majors, crosses, even an emerging market pair.
And what were the 5 chosen pairs from your material?
The 5 selected for the deep dive are Euro USD, GBP JPY, USD CAD, USD SR, and IUD NZD.
Can you quickly tell us why these 5? What kind of themes do they represent based on your sources?
Yeah, it's a good mix that covers the key themes. Euro USD is the big one, right? Highest liquidity, dominated by ECB Fed news. Plus, it's got that strong recent uptrend and the institutional net long EUR positioning we just talked about.
The absolute core pair. Makes sense. GBP JPY.
That's your high volatility cross, really sensitive to UK news like today's GDP and also BOJ sentiment, JPY positioning. And crucially, your sources flag that big divergence. Retail traders are heavily short this pair, while institutions are net long GBP.
Ah, that retail versus institutional split again.
Exactly. That often signals potential for a sharp move, maybe a short squeeze if price moves against the retail crowd. Although the JPY institutional longs complicate that picture a bit.
That's right, USD CAD.
Major pair, but also a commodity currency link. It shows another huge retail skew overwhelmingly long, which is often a contrarian, bearish signal. Institutions are increasingly short CAD, and of course, it's driven by oil prices and the Fed versus Bank of Canada policy gap.
Okay. USDZR, the emerging market pick.
Yeah, included for its, well, exceptional volatility and for diversification. Highly sensitive to global risk appetite, risk on helps the rand. ZAR, risk off hurts it. Linked to gold too. And your sources found it interesting that the ZAR has been strong lately, even with gold pulling back slightly. Suggests other factors are helping it.
And finally, AUD-NZD, the Trans-Tasman cross.
This one's at a key technical point, according to your sources. Lots of talk about a potential breakout or reversal. And guess what? Another big retail long position, suggesting contrarian bearish risk, driven mainly by RBA versus RBNC policy expectations and regional commodity stuff.
So these 5 really give a good taste of the main themes. G10 policy battles, commodity currency dynamics, that JPY positioning risk, and a look at EM. Okay, let's dive into the specifics for each, pulling from the technicals, fundamentals, sentiment, all that analysis in your sources, starting with USD.
Okay. Looking at the charts for USD, your sources show a strong medium-term bullish trend. Price generally heading up in a rising channel, trading above key moving averages too.
Trend looks solid then.
Trend is up, yeah. But the daily RSI, that momentum indicator, it's rising but getting close to 70.78. That's near overbought territory. Suggests the move up might be getting a bit stretched, maybe do a pause or a pullback.
So the trend is your friend, but maybe hitting a bit of a speed bump.
That's a good way to put it. Price is coming up to key resistance from the year-to-date highs, around 1.1572 to 1.1575. That's where rallies have stalled before.
Right, a tough ceiling. Where's support?
Support levels identified are around 1.1480, 1.1500. Below that, maybe 1.1360, 1.1380. A clear break above that 1.1575 resistance. That could target 1.160, and some sources even mention potential longer-term targets like 1.20 or 1.25 if this bullish momentum really holds.
Fundamentally, you mentioned the interest rate difference favors the USD right now. Higher yield holding dollars and euros, but the market's looking forward, isn't it?
Exactly. The current rate gap does favor the dollar, yeah, the carry trade idea. But your sources stress the market is focused on the future path, today's strong US PPI. It dampens hopes for quick Fed cuts, which gives the USD a bit of support.
But the ECB.
But the ECB having cut and maybe pausing now, that limits how weak the euro might get. And crucially, that big institutional net long position in EUR futures plus 82.8K, that's a significant vote of confidence for the euro from the big players. Asset managers are also trimming their USD index longs, apparently.
And how has USD actually performed lately? Does it match the bullish view?
Short-term performance confirms it. Strong positive results over the last 7 days, up 1.5%. Over the last 30 days, up over 3%. So yeah, the bulls have definitely been in charge recently.
But that strength near resistance and overbought signals increases pullback risk.
Increases the mathematical chance of mean reversion, yeah. Price pulling back towards its average, or maybe just consolidating sideways for a bit.
What's the sentiment picture telling us for EUR USD, according to your sources?
Okay, so institutional sentiment from that COT report, clearly bullish euro, plus 82.8K net long. Retail sentiment, though, mixed to moderately bearish. Sources show maybe 54% to 60% of individual traders are net short.
So the crowd is betting against the big money.
Often, yeah. And that split is seen as a contrarian bullish signal. Potential for a short squeeze if price pushes higher, forcing those retail shorts to buy back and cover, adding fuel to the move. Social media seems divided, reflecting that technical battle at resistance. Plus, the broad US dollar index looks weak near support, which is generally a tailwind for URUSD.
If you were using, say, sophisticated AI models, how would they approach this based on your source material?
Conceptually, models would pick up that bullish momentum but flag that 1.1575 resistance as critical. Order flow analysis would be key, watching where big institutional orders are clustered. Buy orders near support like 1.15 sell orders near resistance at 1.1575. That helps gauge pressure. Tools like volume profile, cumulative delta would refine those levels and assess the conviction behind moves.
Okay, so pulling it all together for URUSD, what's the overall forecast bias from your sources?
They lean towards a cautiously bullish bias. The uptrend, the broad USD weakness, institutional support, those are the positives. But caution comes from that strong resistance being tested, the potential overbought signals, and today's conflicting US inflation data muddying the Fed picture a bit.
Target zone. Confidence.
Target zone suggested is 1.150 to 1.1620. Confidence is moderate, maybe a 6.5 out of 10. And it really hinges on price holding above that 1.1480, 1.150 support. Expect high volatility around that 1.1575 resistance area.
All right. Moving on to GBP-JPY, the volatile one.
Definitely known for its sharp moves. Technically, it's consolidating right now, kind of stuck in a range near the May highs, around 196.25, 196.38. This is after bouncing strongly off its 200-day moving average, a key long-term level.
Is it above other key averages?
Yeah, it's above key shorter-term daily EMAs, suggesting the shorter trend is up. But the daily RSI, while not as high as your USD's, is nearing 62. So momentum is strong but approaching overbought, and some analysts in your sources see a potential pattern, a triple top forming near those highs.
The triple top. That would be bearish if it plays out.
Exactly. If price fails to break higher and instead breaks down from this consolidation, that pattern would suggest a potential decline.
What are the key price levels to watch here, according to your sources?
Okay, support levels. Around 195.00, then 194.75, 194.80. Lower down, 193.80. One source mentioned 191.86 as critical support. Below that, the 200-day average. Resistance is near 195.85, 196.00, and then that key May high zone, 196.25, 196.38.
And a break above that May high.
Would target 197.00 first, then potentially the year-to-date peak up near 198.25.
Fundamentally, we've got that tricky UK picture, weak GDP, high wages. How does that weigh against the Bank of Japan's stance?
Well, that potential UK stagflation worry definitely puts pressure on the pound, fundamentally. On the flip side, the BOJ is still very dovish, rate at 0.5%, UEDA signaling patience on hikes.
So the interest rate difference is still huge, favors holding pounds.
Massively favors GBP over JPY, yeah. That supports the carry trade appeal buying GBP JPY, but, and this is a big but, remember that huge institutional net long position in the yen from the COT report, plus 151K.
Right, the massive yen longs.
If institutions are betting that strongly on yen strength, it could really weigh on GBP JPY, even with the rate differential favoring sterling. It makes the fundamental picture quite complex. Safe haven flows into the yen if risk aversion picks up, maybe from tariff news is another factor.
You mentioned the COT divergence earlier. Let's look at sentiment specifically for GBP JPY. It sounds dramatic.
It really is striking here. Retail traders. Extremely net short GBP JPY. Forex.com showing around 72% short. IG maybe 62, 65% short.
That's heavily skewed.
Very heavily. And from a contrarian perspective, that's a strong bullish signal. Huge potential for a short squeeze if price pushes higher. But institutional sentiment is mixed, remember. They're net long GBP, but very net long JPY. Social media reflects this conflict, debating the bearish triple top versus bullish targets higher.
How might AI simulations handle such a volatile, conflicted pair?
Well, given the volatility, Monte Carlo simulations would show a really wide range of possibilities. Order flow tools would be critical, watching institutional buying near support, like 194.75, 195.000, and selling near resistance like 196.00, 196.30. And crucially, tracking that huge JPY speculative long position. Are they covering bullish GBP JPY or adding bearish? Pattern recognition would focus on confirming or invalidating that triple top.
So what's the overall forecast bias from your sources for GBP JPY? JPY?
It's described as neutral to cautiously bullish bias, mainly because it's stuck in consolidation right now. There's an underlying bullish tilt from some technicals, and especially that extreme retail short sentiment. But big headwinds exist. UK fundamental weakness, potential yen strength from that positioning, and the technical risk of the triple top pattern.
So range bound for now.
Yeah, the target zone reflects that, 194.5 to 196.50. Confidence is pretty neutral, 5 out of 10, because of all the conflicting signals. Direction really depends on which way it breaks out of this range.
Makes sense. Okay, let's move on to USD CAD.
All right, USD CAD. Technically, it's in a pretty clear, bearish, medium-term trend. Lower lows, lower highs. Looks like it's in a descending channel.
So trend is down.
Trend is down, yes. But your sources point out some signs the downside momentum might be fading a bit. The daily RSI shows bullish divergence.
Bullish divergence. What's that again?
It's where the price makes new lows, but the RSI indicator doesn't make a corresponding new low. It suggests the selling pressure might be weakening. There is also a potential falling wedge pattern forming, which is often seen as a bullish reversal pattern.
So bearish trend, but some technical signals flashing maybe a bounce or reversal?
Exactly. It's testing key moving average levels right now, too. Support is seen around 1.3685, 1.3700, then 1.3645, 1.3650, that's near 8-month lows, and then 1.3600. Resistance is at 1.370, 1.370, 1.3730, 1.3750, and 1.3750, 1.3750.
And the triggers.
Fundamentally, this one isn't just about central banks, is it? Oil prices matter a lot.
Absolutely. CAD is a commodity currency, so oil is a huge driver.
Yeah.
Policy divergence between the Fed and Bank of Canada is key, too. Today's strong U.S. PPI. That might slightly slow down expectations for Fed cuts, giving the USD side a little temporary support.
Any Canadian factors mentioned? Your sources mention things like Canada's balance of payments deficit, potentially softer domestic demand, possibly weighing on the CAD as well.
And how does that institutional positioning from COT fit in? The shorts on CAD.
Right, institutional COT shows those increasing net short positions in CAD futures, minus 108.4K now. It's a significant bearish bet by speculators, aligning with the downtrend, but also showing how big money is leaning.
How has it performed recently? Does that match the downtrend?
Performance lately confirms the bearish momentum. Slightly down over the past week, but down over 2% in the past month. So momentum has been negative, but again, that RSI divergence, the falling wedge, they suggest momentum is slowing, increasing the risk of a mean reversion bounce.
Sentiment sounds pretty skewed here, too. Retail traders.
Oh, yeah. Retail is overwhelmingly net long USD seed. Forex.com showing around 70% betting on price going up.
Against the trend and against institutional positioning.
Exactly. It's a strong contrarian bearish signal. Increases the potential for a painful squeeze lower for those retail longs. Social media is watching the downtrend, but also talking about that bounce potential from support or the wedge. And broad USD weakness has been a big factor pushing USD CAD down.
How would quantitative models tackle USD CAD?
Well, they'd need to bake in that oil price correlation, the US-Canada rate differential impact. Monte Carlo simulations would likely show a downside bias, but flag that bounce risk from the technical signals. Order flow would watch support around 1.3685, 1.3700 for institutional buying, and resistance near 1.3730, 1.3750 for selling. Tracking those CAD futures shorts is important. Pattern recognition would analyze the odds of a valid breakout from that falling wedge.
So the overall forecast bias for USD CAD from your sources?
It's described as bearish with potential for a corrective bounce. The main trend is down channel, weak USD, retail sentiment all point that way. But that bounce potential from the technical divergence and wedge, plus being near support, is significant.
Target zone. Confidence.
The target zone reflects both possibilities. 1.3640, 1.3760. Allows for more downside or the correction up. Confidence is moderate, 6 out of 10. Bearish trend is clear, but the risk of a bounce is definitely high right now.
Okay, let's get into USDZR, the emerging market pair.
Right, the RAND, an exotic high volatility pair. Technically, the prevailing sentiment here is bearish, according to your sources. It's broken key support levels. Daily technical ratings often say sell. Prices below the daily Ichimoku cloud, MCD momentum is negative.
So mostly bearish signals. Any chance of bounce?
Well, because it's falling quite sharply, there's potential for an oversold bounce on shorter time frames, yeah.
What are the key technical levels your sources are watching for USDZR?
Support is near 17.69, 17.70. Below that, major support at 17.50. Potentially even 17.40 if the bear bearish move really extends. Resistance is near 17.715 honor, 17.750, and then 17.8150, 17.850. The 20-day moving average is acting as resistance. That 17.70 level is highlighted as a key short-term pivot.
Fundamentally, you mentioned global risk, gold, but also domestic factors helping the rand recently.
Yes. The South African Reserve Bank, the ASRB, cut rates recently to 7.25%. But interestingly, your sources say the rand has been strong lately, even with gold pulling back a bit. They attribute this to things like improved domestic sentiment in South Africa, better SARB reserves, maybe a better outlook perception.
So not just about gold.
Not just gold, no. Global risk sentiment is still huge, though. Risk on tends to help ZIR, risk off, like tariff fears, hurts it, pushing USD ZIR up. And the institutional COT also shows significant net short ZIR positions by speculators, which, if covered, could actually fuel more ZIR strength.
How has USD ZIR performed recently then, confirming the ZIR strength?
Strongly confirms it. Down significantly over the past 7 days, nearly 0.5%. And down almost 4% over the past 30 days. That break below 1800 and the 200-week average were big technical confirmations of the bearish view.
But you mentioned overextended.
Yeah, your sources note it's statistically overextended. The price move has been very large compared to its usual behavior. That increases the mathematical chance of a corrective bounce, even if the main trend stays down. And volatility is predicted to be very high, over 7% weekly.
Sentiment here sounds extreme.
Extremely extreme, you could say. Retail traders are overwhelmingly net long USDZR. CMC markets showing 83% long.
83%? Wow.
Yeah, that's one of the strongest contrarian bearish signals you can get. The vast majority of the retail crowd is betting against the dominant trend in institutional positioning. Sets the stage for a potentially major squeeze lower. Institutional COT, as mentioned, is net short ZER, which aligns with the trend but clashes massively with retail.
What would AI simulations focus on here?
They'd have to heavily factor in that high volatility, the links to risk sentiment, commodities. Monte Carlo would show a wide distribution but likely skewed to more downside given the trend and technical breaks. Order flow would watch that 17.70 support and especially the 17.50 level for signs of institutional buying. Monitoring those institutional ZR shorts, are they adding or covering, is vital. Pattern recognition would look for breakdown signals or exhaustion signs hinting at a bounce.
Okay. Overall forecast bias for USDZR from your sources.
The bias is clearly bearish. You've got strong momentum, technical breakdowns, that incredibly potent retail sentiment signal. Supported also by the improved domestic factors for ZR and broad USD weakness. However,
the bounce risk.
Exactly. The high volatility and the statistically overextended nature mean the risk of a corrective bounce is significant, and any bounce could be sharp. So the target zone is wide, 17.5000, 17.850. Confidence is relatively high at 7 out of 10 on the bearish view itself, but managing that volatility risk is absolutely key.
Got it. Last pair in the deep dive, AUD, NZD. This one sounds like it's at a crossroads.
It really does seem to be at an inflection point, yeah. Technically, your sources point to signs of a potential trend shift. It's trying to break above a bearish trend line and maybe out of a descending triangle pattern. Both would be bullish signals if confirmed.
But there are conflicting signals.
Yes. Some technical rating models mentioned in your sources still give the daily picture a strong sell rating, so it highlights the conflict. There's also potential bullish divergence noted on shorter time frames. It's really a mixed bag technically right now.
Where are the key levels for AUD, NZD?
Support is seen near that potentially broken trend line, maybe around 1.0750, and also recent lows near 1.0650, 1.0660. Resistance is near 1.08150 and 1.0860. A clean breakout above resistance needs confirmation, ideally with good volume, to really suggest the trend is changing.
Fundamentally, it's driven by the RBA and RBNZ in commodities.
Correct. The Reserve Bank of New Zealand cut rates in May to 3.25% and signaled more cuts. But the Kiwi actually strengthened a bit after that, maybe because it wasn't as dovish as feared, or it was priced in. Meanwhile, stronger Aussie inflation data recently reduced expectations for RBA cuts.
So the policy outlook is a bit murky.
Yeah, and some analysis in your sources, like from ING, suggests the RBNZ might be cautious about further easing now. If so, that could actually favor the NZD relative to the AUD, especially in calmer market periods, maybe eroding the Aussie's usual rate advantage.
And how does institutional positioning look in the COT report for these two?
Institutions are net short both, but relatively more bearish on the Aussie dollar, negative 63.2K short, than the Kiwi, negative 23.7K short. So that relative positioning might favor NZD over AUD.
What about recent performance? Has it shown any clear direction?
Not really. Mixed over the last 7 days, basically flat, slightly negative over the past 30 days, down maybe 0.8% to 1%, reflects that consolidation near the potential trend break. No strong short-term momentum either way right now.
And sentiment, another skewed retail picture.
You guessed it. Retail traders are extremely net long AUD NZD. IG showing around 75% long, another strong contrarian bearish signal. Institutional sentiment, as per COT, relatively more bearish AUD. Social media is debating. Is this a real bullish breakout, or is it going to fail again? Global risk matters less directly here, but RBNZ caution might make NZD look better in stable times. How would AI sims handle this inflection point?
Focus would be on range trading signals, potential trend shifts, incorporating RBA-RBNZ divergence, commodity links. Monte Carlo might show higher odds for upside if resistance breaks convincingly, but also a significant chance of failure given the prior trend and that retail long positioning acting as a headwind. Order flow would watch the retests of the broken trend line and resistance levels for volume confirmation of breakout or failure. Pattern recognition would assess the validity of that triangle trend line break.
So the overall forecast bias for AUD/NZD from your sources? It's neutral to cautiously bearish bias. Technicals are mixed, very indecisive, but that strong retail long position is a big contrarian bearish flag. Institutional COT is relatively more bearish AUD. The slight negative performance recently suggests the path of least resistance has been lower. Potential bullish patterns need confirmation. They haven't proven themselves yet.
Target zone and confidence.
Target zone reflects the indecision. 1.0720, 1.0830. Confidence is moderate, maybe 5.5 out of 10, just because the signals are so conflicting. Whether price can hold above that broken trendline area, roughly 1.0770/1.0790, that seems crucial for the near-term direction.
Okay, that covers the deep dive into the 5 pairs chosen from your sources. Now, based on all this analysis data, policy, technical sentiment, your sources actually proposed one specific actionable trading strategy. Which pair was that for?
Yeah, looking at the whole picture, the confluence of factors, especially that strong technical breakdown and the extreme retail sentiment aligning with the trend, the proposed strategy from your sources is for USDZIR.
Okay, USDZR, the one with the clear bearish bias and relatively high confidence. What's the specific strategy suggested?
The strategy is framed as sell on rally or confirmation of resistance. The thinking behind it is based on that strong bearish trend, the technical breaks below support, the extreme retail longs acting as that contrarian signal, and the broader USD weakness. So the idea is to look to sell if price bounces up into resistance and stalls, or sell if it confirms more downside by breaking immediate support.
Got it. And did your sources provide specific recommended levels? Entry, take profit, stop loss?
They did. The recommended entry zone was to consider selling in the area of 17.80000000, if price rallies there and shows rejection signs, like bearish price action. An alternative entry mentioned was selling a break below immediate minor support, maybe using 17.65000.
And targets and stops?
Take profit levels suggested were TP1 at 17.550 and TP2 down at 17.980. For an entry around the middle of that rally zone, say 17.820, the stop loss suggested in the source was placed at 17.980.
Yeah, let's just quickly look at the risk reward on that. If you enter at 17.82, stop at 17.98, that's 160 pips of risk. Targeting TP1 at 17.55 gives 270 pips reward, about 1.7 to 1. Targeting TP2 at 17.40 gives 420 pips reward, roughly 2.6 to 1. So favorable risk reward according to the source.
Correct. Those are the levels and the resulting RR calculations provided directly in your source material for that specific USDZR strategy.
Fascinating stuff. Okay, so to wrap up this deep dive into your sources, we've really covered a lot of ground, navigated those central bank policy shifts, especially post-ECB cut, and now facing new Fed questions after that hot PPI data.
Yeah, and we explored the UK's really challenging picture, that potential stagflation headache for the Bank of England with slow growth and high wages.
We looked at the commodity currencies, CAD, AUD, NZD, how they're positioned, what's driving them, plus the emerging market angle with Iran.
And maybe most compellingly, we kept highlighting those really stark divergences, didn't we, between what retail traders are doing and where the big institutions are placing their bets, particularly in pairs like GBP, JPY, and USDZR.
Absolutely. Analyzing your specific sources really gave us this multi-layered view. It shows that while some trends seem strong, like the bearish case for USDZR, a lot of pairs, like EURASD or AUDNZD, are really at key technical and fundamental crossroads right now.
Yeah, confidence definitely varies across these forecasts, which just underscores how nuanced things are. And as always, risk management is just paramount, isn't it? Especially in these volatile conditions, watching those key technical levels, watching incoming data, it's crucial.
Definitely. And this whole exercise, digging through your sources, it really raises an important final question for you to think about as you process all this analysis. Despite everything we've looked at, data, policy, charts, how significant is that disconnect we saw between the crowd, the retail traders often seeming trapped on the wrong side, and smart money, the institutions revealed in the COT report? Does that sentiment divergence, especially when it gets extreme, actually offer more predictive power than all the other analysis combined?
That's a powerful thought to leave you with, for sure.
Thank you for sharing your sources for this deep dive.